Welcome to the Deep Dive, where we cut through the noise and get straight to the strategic core of earnings calls.
Today, we're unpacking the third quarter 2025 results for ICL Group,
A major player in mineral resources and specialty chemicals. And this one is fascinating.
It really is. The mission today isn't just about reading the numbers. It's about understanding this profound strategic U-turn, this, major portfolio reset that management announced.
Right. And that's the central tension here, isn't it? They posted some objectively strong results.
Exactly. Strong year-over-year growth in sales in EBITDA.
But the market reaction was, well, pretty negative.
Punishing, actually. The stock closed down nearly 3% on the day. Investors are clearly weighing the risks of this big shift and, I think, mourning the loss of a major growth story.
Okay, let's unpack that. We need to hit the key financials first to really understand why investors felt so conflicted.
Let's do it. You have to start with the classic beat and miss. Adjusted diluted EPS came in at 10 cents.
Which beat consensus, but only just.
Only just. The consensus was 9.5 cents, so it's a small 5% victory. But that was completely overshadowed by the top line.
The revenue miss.
A big one. Revenue hit $1.853 billion, missing the target of $1.97 billion. A 6% miss.
So even with sales up almost 6% year over year, that miss signals that something somewhere is getting squeezed.
And it showed up in the margins. Adjusted EBITDA was $398 million, up 4%.
Sounds good, right?
Until you look at the margin percentage.
Exactly. The EBITDA margin slipped to 21%, down from 22% a year ago.
And that's the first major red flag for an investor.
It is. Gross margin was also down a full point to 33%. When you see growth but shrinking margins, it tells you cost pressures are mounting faster than they can manage.
And in this case, it was raw materials.
Precisely. Which leads to this new buzzword from management, capital discipline.
Let's talk about that discipline. The dividend, that's a huge signal.
A huge signal. ICL trimmed it down to about 4.8 cents a share from over 5 cents last year. Now, is that a minor tweak or a real sign of caution?
It's definitely a sign. I mean, management frames it as saving cash to invest in their new specialty engines.
But investors see a cut. They see management pulling back.
They see them needing the cash, especially since operating cash flow dropped pretty significantly, down to $308 million from over $400 million the same time last year.
So the balance sheet is still strong.
Oh, yeah. The balance sheet is robust. Net debt to adjusted EBITDA is a very manageable 1.4 times. But the cash flow, it suggests a pause, not an acceleration.
Okay, that focus on stability brings us perfectly to the biggest news, the thing that overshadowed all these numbers.
A definitive strategic pivot.
The U-turn on LFP. For anyone who doesn't follow this closely, LFP is lithium iron phosphate.
And it was ICL's big high-growth bet on the future, on EV batteries.
And now?
It's over. ICL is discontinuing the planned LFP cathode projects in St. Louis and in Spain. They're retreating. They're now just going to be a raw material supplier to the battery industry, not a key producer.
What drove that? I mean, I know they lost some anticipated funding, some government subsidies, but is that enough to just abandon a multi-billion-dollar growth engine?
Not entirely. I mean, losing the DOE and EU funding definitely forced their hand, but the deeper reason was just, economic reality.
The market changed.
The market fundamentally changed. LFP production is quickly becoming this game dominated by huge, heavily subsidized Chinese producers.
So for ICL to compete, it would have been a race to the bottom on price.
A high capex, low return nightmare. They were looking at investing something like $1.5 billion into these projects.
So let me push back on that capital discipline narrative for a second.
Yeah.
Isn't this just corporate spin for admitting they completely misread the EV market a couple years ago?
I mean, yes and no.
They promised this incredible growth optionality, and now they've just walked away. That has to be why the stock tanked.
It is, but you could also frame it as a financially sound retraction. It takes real managerial courage to kill a growth story that investors loved. They're banking their entire reputation on the idea that stability and incremental specialty growth is better than shiny, uncertain future tech.
And you really understand that decision when you contrast the LFP exit with the other massive piece of news.
The news that secures the bedrock of the entire company.
The Dead Sea concession.
Yes. The memorandum of understanding, the MOU, they signed with the state of Israel. This site is everything for them. It's the core engine for potash and bromine.
And the current deal expires in 2030, which has been this huge cloud hanging over the company for years.
A huge structural overhang. It was really hurting their valuation multiple because of the uncertainty.
So what certainty did this new MOU provide?
It basically removed the risk. This is the crucial part. ICL secured compensation of roughly $2.5 billion plus harvesting costs if they are not awarded the next concession.
Wow, so that's an insurance policy.
It's a massive insurance policy. It guarantees that even in the worst case scenario, their core asset doesn't just vanish. It puts a floor on the value of the entire company.
That's immense. So they traded the high-risk, high-capex potential of LFP.
For the high certainty, valuation-enhancing protection of their core assets. It's a defensive move, but a brilliant one. It de-risks the entire enterprise.
And they're probably the most likely candidate to win the new concession anyway.
Management thinks so. They have over 100 years of operational knowledge at that very unique site. So yeah, this MOU is a huge deal.
Okay. Let's drill down into the segment performance now, because this is where we really see that margin compression.
This is where you see the stark divergence between the stable backbone and the more volatile future.
Starting with potash, the bedrock.
Potash was outstanding, just fantastic. Sales up 16% to $453 million. That drove a massive 41% increase in EBITDA to $169 million.
Just rock solid. The potash price was strong too.
Very strong. Hit $353 per ton CIF, which is up 19% from last year. Potash is absolutely doing the heavy lifting. It's generating the cash they need for this new strategy.
Okay, but then we get to the two specialty segments, the ones that are supposed to be the future, and they were hit hard.
Yeah, first, industrial products was mixed, sales down a little, but EBITDA actually grew 3%. Flame retardants were soft because of weak construction markets, but other areas are strong.
The real pain points, though, were in phosphate solutions and, more critically, growing solutions.
In phosphate solutions, EBITDA was down 4%. And the culprit was pretty clear.
Sulfur.
Higher raw material costs, especially sulfur, it just squeezed profitability, even though sales volume was up 5%.
It's tough to grow margins when your key input cost spikes.
Impossible. But on a positive note for their new strategy, the specialty food phosphates part of that business had its strongest quarter in 2 years. So there's a bright spot.
Okay, let's focus on growing solutions, because this is one of the two new profitable growth engines, and it really struggled. Sales up 4%.
But EBITDA fell a steep 22%, a huge drop.
What does that mean for their whole specialties growth thesis?
It means they're facing serious macro challenges, specifically in Brazil, and that market is a cornerstone of their growth plan.
So what happened in Brazil?
Farmer affordability just plummeted. You had tight credit, high domestic interest rates, and farmers just reacted. They deferred buying things.
And they especially held off on buying the premium products.
The very products that are supposed to drive ICL's margin expansion, the specialty fertilizers, the high-end stuff, demand just dried up.
So that raises a big question. If your whole thesis relies on selling these high-margin premium inputs, and a key market like Brazil just steps buying them, how stable is this new strategy, really?
That is the definitive question for 2026. The volatility in Brazil really undermines the perceived stability of the whole specialty segment.
And it puts huge pressure on management to prove this pivot can actually deliver.
Exactly. So with that in mind, let's pivot to these two new profitable growth engines that are now getting all the capital that LFP would have eaten up.
Right. The new strategy is all about hitting organic growth rates over 6%.
By prioritizing two areas, specialty crop nutrition and specialty food solutions, they want to evolve from being a cyclical producer to a specialty tilted cash generative platform.
Okay, so engine number one, specialty crop nutrition. That's inside the growing solutions segment that just saw that 22% drop in EBITDA. How do they plan on hitting mid-double-digit margins there?
It's all about portfolio optimization. They're going to shift the product mix towards the really high margin stuff. Biostimulants, nutrient use efficiency solutions like biodegradable controlled release fertilizers.
And they're also looking at new geographies to diversify away from places like Brazil.
Exactly. Targeted expansion in high growth places like India and China. The idea is to spread the risk.
And the second engine, specialty food solutions. This one seems much more transformative.
This is where the ambition is huge. Right now, they lead a pretty narrow $1.5 billion market in phosphate food specialties.
And the goal is to expand into the much, much broader functional food ingredients market.
A $35 billion market. We're talking preservatives, texturants, leavening agents, the whole 9 yards.
How do they plan to do that?
They're leveraging their existing relationships. I mean, they already work with 7 of the top 10 biggest food companies in the world, so they have the connections. It'll be a mix of M&A and R&D.
And they also mentioned using AI pretty extensively to drive efficiency, which sounds like a direct response to those raw material squeezes we saw.
It's precisely that. They're trying to use technology to transform their internal operations, their supply chain, to find those extra margin points.
So did they reaffirm guidance?
They did. They're sticking with their key 2025 targets. So the story now is 100% about execution, proving that ditching LFP was the right call, not a missed opportunity.
So, key catalysts to watch for.
First, concrete M&A. We need to see them actually spend money on a food or crop nutrition company. Second, progress on the final Dead Sea framework. And third, and this is critical, the next update on agricultural demand in Brazil. If Brazil stays soft, the risk skyrockets.
Okay, this is not financial advice segment.
Yeah.
This is purely for speculative amusement and intellectual consideration.
Right. So given ICL's huge U-turn, getting out of the high-growth, high-capex EV story and going back to their stable mineral roots, the market is struggling. It doesn't know what to do with them.
Which creates an opening.
An opening for a speculative, outrageous, but plausible trade idea we're calling the specialty safety paired bet.
Okay, I like the sound of that. Trading volatility for certainty. Lay it on us.
The thesis is simple. The market is punishing ICL like it's just a volatile fertilizer company that lost its future. We're assuming management is right, and that the company is now an attractively priced, stable materials play with a cash-generating machine in potash.
Okay, so what are the mechanics of the trade?
You go long ICL stock. You're buying that discounted stability and capital discipline.
And you pair that with?
A short position in a high-beta, pure-play battery materials company. Specifically, you find a smaller supplier that's really exposed to the LFP component value chain.
Ah, so you're betting on ICL management's strategic wisdom against the very industry they just abandoned.
Exactly. You profit if ICL's quiet 6% plus organic growth proves to be a more stable and profitable path than the, highly volatile, subsidized, margin-pressured battery supply chain they just walked away from.
It's a bet that boring cash flow wins over expensive, uncertain new energy optionality.
That's the bet. And again, this is purely speculative and highly risky.
That wraps up our deep dive into ICL's Q3 2025 call. I think the key takeaway is that this quarter was so much less about the slight EPS beat and much more about this radical portfolio reset.
Absolutely. They traded the potential for a home run in LFP for a much higher probability of a solid triple in food and crop specialties.
The company is now all about execution. They de-risked their core asset with that Dead Sea MOU, but they face immediate execution risk in these new growth segments.
And that's the question for 2026. Can these new specialty engines outrun the volatility and margin pressure we're seeing right now in Brazil and from raw material costs like sulfur, the performance of that expansion into the broader food market? That will be the tiebreaker.
Absolutely. Thank you for joining us for this deep dive.